Hi, I'm Tom Grant from TD Asset Management, and I'm here to talk about some of the misconceptions around ETFs. The first misconception is that ETFs are just like mutual funds. While ETFs and mutual funds have some similarities, they're actually quite different in terms of how they're structured and transacted. Both ETFs and mutual funds are investment vehicles that pool money from many investors to invest in a portfolio of stocks, bonds, or other assets. However, there are several key differences between ETFs and mutual funds. Firstly, ETFs trade on a stock exchange, like individual stocks, which mean they can be bought and sold throughout the trading day at market prices. Mutual funds, on the other hand, are priced and traded at the end of the trading day, at a net asset value, or NAV, of the fund. Secondly, mutual funds may have minimum investment requirements, while ETFs typically do not. Additionally, ETFs offer greater flexibility than mutual funds because investors can trade them like stocks, use limit orders, and even short sell them. Overall, while there are similarities between ETFs and mutual funds, they are distinct investment vehicles with different features and characteristics. The second misconception is that ETFs are just like stocks. An ETF, or an exchange-traded fund, is a type of investment fund that is traded on a stock exchange and similar to stocks. However, there are several key differences between ETFs and stocks. Firstly, ETFs are funds that hold a diversified basket of underlying assets such as stocks, bonds, or commodities. By investing in an ETF, you are essentially buying a piece of a diversified portfolio of assets which can provide exposure to a particular sector, industry, or market index. On the other hand, when you buy a stock, you're buying a share in an ownership of a specific company. The value of a stock is determined by the performance of the company and its financials, such as revenue, earnings, and profit margins. Stocks are typically bought to gain exposure to a single company, whereas ETFs are designed to provide investors with exposure to a diversified portfolio of assets. Investing in individual stocks can be riskier than investing in ETFs, as the success or failure of a single company can have a significant impact on the value of a stock. In contrast, ETFs provide investors with exposure to a diversified portfolio of assets, reducing the impact of a single company's performance on the overall value of the investment. In summary, ETFs and stocks are both traded on stock exchanges, but ETFs are diversified funds that hold a basket of underlying assets, while stocks represent a specific ownership in a specific company. Another misconception is high volume is a good indicator for an ETF. One common misconception about volume is that it indicates the overall fitness of an ETF. We like to remind investors that volume alone does not necessarily provide a complete picture of an ETF's popularity or performance. The volume of an ETF represents the number of shares that have been traded in a particular day. While volume can be an important factor to consider when trading stocks, it can sometimes miscommunicate information about an ETF. For example, an ETF with low trading volume may be an attractive investment if it has a strong track record of performance or aligns with an investor's overall investment strategy. Conversely, a high volume trading ETF does not necessarily mean that the ETF is performing well or that its underlying assets are in high demand. It could simply mean that there is a lot of buying and selling activity in the marketplace, which might be due to short-term market fluctuations or intermediated trading. Therefore, while volume can be a useful indicator of a stock's liquidity, it shouldn't be used in isolation to make investment decisions when it comes to ETFs. Investors should also consider other factors such as the ETF's performance, expense ratio, and the market activity when evaluating an ETF.